Most people investing right now have no idea that the biggest Wall Street banks are sitting on predictions that contradict each other so sharply they cannot all be right. One of them is going to be spectacularly wrong, and if you are positioned on the losing side of that bet, it will cost you. The S&P 500 finished 2025 having already delivered 2 consecutive years of gains above 20%. That almost never happens. In the entire history of the index, it has only occurred a handful of times. So the question every serious investor should be asking right now is not whether the market went up. It is whether that kind of run can possibly continue, and what happens to your portfolio if it cannot. Here is the uncomfortable truth most people are sitting with heading into 2026. They rode the wave up, they felt smart, and now they have no idea what to do next. Selling feels wrong because what if the market keeps climbing? Buying more feels reckless because valuations are stretched, and everyone on financial Twitter is screaming about a crash. So they do nothing. They freeze. And freezing is its own kind of decision, one that tends to go badly when the landscape is shifting underneath you. The average retail investor right now is holding a portfolio shaped by 2 years of euphoria, tech-heavy, momentum-driven, and not particularly diversified. That worked beautifully in 2023 and 2024, but the conditions that made it work are quietly changing, and most people have not noticed yet. So let's talk about what the people with the most sophisticated research teams on the planet are actually saying about where this market goes from here, and more importantly, what that means for you specifically. Goldman Sachs entered 2026 with a year-end S&P 500 target of around 6,500. That implies modest, single-digit gains from where the index started the year. Their core argument is that earnings growth will remain solid. Corporate America is still healthy, and the economy managed to avoid the recession everyone spent 2 years predicting. They are not euphoric. They are cautiously optimistic, which from Goldman is basically as warm as it gets. Morgan Stanley came in with a more conservative posture. Their strategists pointed to elevated price-to-earnings ratios as the central concern. When you are paying a high multiple for every dollar of earnings a company generates, you need those earnings to keep growing fast just to justify the price you already paid. If growth slows even slightly, the multiple compresses, and the stock drops even if the underlying business is fine. That is the trap embedded in an expensive market, and Morgan Stanley thinks we are sitting right in the middle of it. J.P. Morgan landed somewhere between the two, acknowledging that the bull case is real, but flagging specific risks that could derail it. Their analysts pointed to interest rates as the swing factor. If the Federal Reserve cuts rates more aggressively than expected, that could pour fuel on an already hot market. If inflation proves stickier than hoped, and the Fed holds rates higher for longer, the multiple compression Morgan Stanley is worried about becomes much more likely. What you are seeing here is not confusion. It is disagreement about which of 2 very different futures actually plays out. And the honest answer is that nobody knows. What you can do is understand the scenarios clearly enough to position yourself intelligently for either one. The bull case rests on 3 pillars. First, earnings. S&P 500 companies are projected to grow earnings somewhere in the range of 10 to 12% in 2026, according to consensus analyst estimates. If that happens, it gives the market fundamental support, even at elevated valuations. Second, the consumer. American household balance sheets came out of the pandemic era in better shape than most people expected, and spending has remained resilient even as rates stayed high. Third, artificial intelligence. The capital spending cycle around AI infrastructure is still in early innings. Companies like Microsoft, Amazon, and Google are spending hundreds of billions building out the foundation, and that spending flows into earnings across dozens of industries. The bear case is also serious. Valuations measured by the cyclically adjusted price-to-earnings ratio, which smooths out short-term fluctuations by averaging earnings over 10 years, are sitting near levels only seen a handful of times in history. Near the peak of the dot-com bubble, briefly in 2021, and now. That does not mean a crash is imminent, but it does mean the margin of safety is thin. When you pay a high price for something, your future returns are mathematically lower, everything else being equal. There is also the concentration problem. The top 10 stocks in the S&P 500 now represent more than 30% of the entire index. If you own an index fund, which most people reading this probably do, you are far less diversified than you think. Your returns are heavily tied to a handful of mega-cap technology companies. If those companies stumble, your broadly diversified portfolio is going to feel it hard. Now, here is the part that almost nobody is talking about, and it reframes everything you just heard. The years when analysts and strategists are most unified and confident in their predictions are historically the worst years for accuracy. When there is consensus, the consensus is usually already priced in. The real market-moving events are, by definition, the ones that the models did not see coming. In 2025, the thing that surprised everyone to the upside was the resilience of corporate earnings despite high rates. In 2022, the thing that crushed portfolios was the speed and severity of the rate hikes that almost no one predicted correctly. The market does not reward you for knowing what is going to happen. It rewards you for being positioned in a way that survives what you did not see coming. That shifts the entire frame of how you should be thinking about 2026. Instead of trying to guess which Wall Street forecast turns out to be right, the smarter question is, what does your portfolio look like if the optimists are wrong, and are you okay with that outcome? If the honest answer is no, you have some rebalancing to do. If the answer is yes, then let the noise wash over you and stay the course. What this actually looks like in practice is simpler than most people make it. It means not letting any single position or sector grow so large that a bad year for that one area defines your entire result. It means keeping some exposure to asset classes that tend to hold up when growth stocks struggle. Things like dividend-paying value stocks, short-duration bonds, or international equities that are trading at far lower valuations than their American counterparts. It means having enough cash or liquid assets that a market drop feels like an opportunity rather than a catastrophe. The analysts will spend all of 2026 revising their targets up and down as data comes in. Some of them will be right for the wrong reasons. Some will be wrong despite solid analysis. That is the nature of forecasting complex systems. What does not change is the underlying logic of how wealth is actually built over time, which is not by predicting what the market does next year, but by staying invested, staying diversified, and making decisions based on your own financial situation rather than the loudest voice in the room. You do not need to know which forecast is right. You need to know what you own, why you own it, and what you will do in either scenario. That clarity is worth more than any year-end price target.